Welcome, everyone, to The Explainer. This is where we take dense, institutional reports, raw data, and complex financial concepts and turn them into something you can actually use. Today, we're cracking open a really fascinating financial vehicle, the Invesco India Arbitrage Fund. Let's dive right in. So picture this. It's the ultimate beginner investor's dilemma, right? You're probably wondering, is there a way to actually profit from the stock market without taking on all that terrifying market risk? You're scared of market crashes, which is totally fair. But you also know that leaving your hard-earned cash sitting in a regular savings account just means losing money to inflation. You want better returns, but you absolutely need safety. Well, finding that middle ground is exactly the problem arbitrage funds try to solve. Okay, let's quickly look at our roadmap for today. We're going to cover what an arbitrage fund actually is, historical performance and volatility, decoding the risk metrics, peering under the hood at the asset breakdown, how it beats benchmarks and peers, and finally, the capital growth reality. First up, what exactly is an arbitrage fund, and what in the world is market neutrality? Think of arbitrage as the incredible exception to the rule of volatile equity markets. It's kind of like a dual market scenario. Imagine you buy an item in a local cash market for 100 rupees, but you happen to know that in a neighboring futures market, someone is willing to pay 115 rupees for that exact same item a month from now. Arbitrage is just buying it for 100 and simultaneously selling that futures contract for 115 to lock in a sweet 15 rupee spread. That price mismatch creates the profit, and it happens completely independently of whether the overall market goes up or down. That brings us to the huge difference between traditional trading and arbitrage. Traditional trading is basically speculating. You buy a stock, crossing your fingers, and hoping the price goes up, which obviously leaves you wide open to market crashes. Arbitrage, on the other hand, uses a fully hedged, long cash, short future structure. You buy the stock and sell the future at the exact same time. Because of this market-neutral setup, the fund literally does not care if the broader market is soaring to new highs or completely crashing. It only cares about capturing those tiny pricing inefficiencies. Moving right along to historical performance and volatility. Basically, how this strategy stays steady in a storm. You know, it's incredibly rare to see anything dealing with equities labeled as safe, right? But the official scheme documentation tells a different story. The benchmark riskometer firmly plants this fund in the low-risk category. For conservative investors, this is ultimate proof from institutional regulators that your principal is sitting in a highly secure instrument. And the reason it's considered so safe? The fund maintains near-zero unhedged equity exposure. It is relatively indifferent to frequent market corrections. Historically, through all sorts of crazy economic cycles and massive market swings, this fund has acted like a giant stabilizer. It's designed to give you steady monthly returns that honestly act a lot more like a liquid short-duration debt fund than a standard stock market fund. All right, let's decode the actual risk metrics. What are the specific safety features we're looking at here? Look at this single standout number, 0.50%. That is the fund's standard deviation over a trailing 3-year horizon. Standard deviation just measures how wildly a fund's returns swing up and down. Having a number this insanely low means the returns barely deviate from their average. It totally proves the supreme stability of disinvestment. Let's rapid fire through the rest of this risk dashboard. The beta is at 0.25, meaning it barely reacts to broad market swings. The alpha is 0.67%, which is that juicy outperformance generated by the fund managers being active and beating expectations. And finally, a Sharpe ratio of 2.42. That is fantastic. It means the fund is delivering a very high return for a surprisingly low amount of risk. Time to open this thing up. Let's peer under the hood at the asset and market cap breakdown. Breaking down the institutional data, we see about 68% of the fund is in equity. But again, remember, that is completely hedged by futures contracts. The rest of the pie is parked in highly secure debt, money market instruments, mutual fund units, and cash. The whole thing forms this rock-solid collateral portfolio that generates its own really safe baseline yield. Digging a bit deeper into that equity portion, we see tons of diversification, which is great for reducing concentration risk. Almost half the stocks are large cap, meaning they are highly liquid, so the fund can jump in and out of trades easily. But check out that roughly 20% midcap allocation. That is crucial. That specific midcap slice increases their potential to capture better arbitrage spreads, all while keeping the overall corporate credit risk super low with a debt-to-capital ratio of just 31%. Now for the ultimate test, beating benchmarks and peers. Let's talk about the competitive edge.
When you stack the direct plan returns up against the NIFT 50 arbitrage benchmark, it is a very clear win for Invesco. Over the 1-year, 3-year, and 5-year horizons, the fund consistently beats the index. Just look at the 3-year span. The fund delivered 7.63% annually compared to the index's 6.42%. That is some incredibly consistent historical outperformance.
And that track record builds a huge case for them against their peers, too. With a massive assets under management of over 28,000 crores, they completely dwarf major competitors like Edelweiss and Nippon India here. They pair a top-tier 1-year return of 6.78% with a super competitive expense ratio of just 0.34%. It's the perfect combo of size, performance, and low fees.
So how do they maintain this edge? Well, the reports point to a few structural advantages. They've got a highly experienced management team that actively manages contract roles with different mandates for every single stock. They also aggressively churn the portfolio to grab dividend arbitrage opportunities, and they lean on that tactical midcap allocation we just talked about. That whole system is exactly how they squeeze out that positive alpha.
Finally, let's talk about the capital growth reality and address a pretty giant myth. It's time to address the elephant in the room regarding what beginners usually want when they hear equity fund. Read this quote, "Not suitable for long-term wealth creation." Boom. I know that sounds like a dramatic record scratch after everything we just praised, but this paradox is absolutely vital. This fund is not a get-rich-quick, high-growth stock. It's not going to double your money in 5 years. It's a proxy for debt. It's built to protect your capital and offer stable yield, not hypergrowth. So if it's not for hypergrowth, how should you actually use it? Here's the playbook. First, identify your idle cash or emergency funds just sitting around in a regular bank account. Second, check your tax bracket, which is super important. And third, park that cash here for short-term horizons, say 3 to 12 months, when you absolutely need liquidity and safety above everything else. Now, that second step about taxes, that is the real secret weapon. Because the fund averages over 65% in equities, the government taxes it like an equity fund. So short-term capital gains are just 20% and long-term are 12.5%. If you are a high-income earner sitting in a 30% tax bracket, the post-tax outcome of this low-risk fund absolutely crushes the after-tax returns of a traditional bank fixed deposit. That is a real game changer. We've seen the data. We know exactly how the strategy works. Knowing how arbitrage completely neutralizes market crashes, delivers steady debt-like returns, and offers highly favorable equity tax benefits, are you still parking your idle cash in the wrong places? Take a hard look at where your portfolio's cash is sitting right now. Thanks for joining us on this explainer, and as always, keep questioning the numbers.